Hi again. We have been talking a lot about achieving financial freedom. So there are three key factors to achieve it, right? Increasing source of income or rationalizing our expenses and managing our investments. In the last episode, I talked about the importance of having passive source of income and its various sources. Today, let's explore the expense management area. Just a standard disclaimer, mainly that this video presentation is for education purpose only and should not be treated as substitute of a professional personal financial advice which differs person to person. So personal finance involves looking at various sources, amount and timing of income and expenses to ensure that there is enough surplus for required investments to meet our future financial goals. So two major tools to manage our expenses are cash flow statement and income and expenditure statement. The cash flow is the starting point of the whole personal finance process. The time and amount of income generated along with the time and amount when it's spent are critical to ensure that there is a proper balance maintained between the two and we don't fall into a debt trap. We must ensure that enough cash from the income is available when the expenses crop up. Even a slight mismatch will lead to the need for a debt which comes at a cost in form of interest. This interest becomes an extra burden adversely impacting the cash flow and reducing the surplus available for investments, and it becomes a vicious circle and a trap. Let's look at the example here. Total inflow is 55K and outflow is 52K. Now, out of this 55K, the automated and certain inflow is only 35K. Then 15K is reimbursed to you when you submit the claim, and 5K is a rent paid by your tenant when he wants to pay, and usually not on a fixed date. Now imagine if in any month you forget or delay in submitting your claims or the employer delays in reimbursing you, then you will end up dipping into your savings to pay the bills, right? Or you will have to borrow loan to make payments, right? Because expenses must be paid. So it's important to keep a track of cash flow and then spend accordingly. Most people do not care about cash flow and they just keep spending from the money in bank account or credit card. I personally do not like it. I do not like withdrawing from my last month's bank balance. My current month's expense must be met from my current month's income. This way my month on month net balance keeps rising. It's a small thing, small concept, but a big impact over a long run. Let's understand the income and expenditure statement. It basically helps us understand where are we actually spending our income, analyze which ones can be or need to be controlled. It also shows how much surplus are we generating to invest in various asset class. If we have complete awareness about our expenses and manage it well, then we can secure our financial future in a better way. Here is an example of the income and expenditure statement. The first list down your incomes from various sources, then take out the mandatory expenses which are employee provident fund, income tax or TDS from various income sources. From that balance, deduct the fixed liabilities like EMIs on any of your loan. Now the balance amount is what you actually have for spending and investing. Rest of the outflow like taxations and EMIs are statutory, are mandatory. You cannot avoid it. You can only manage it. Now from this balance, deduct the essential living expenses. Living expenses are basically your monthly bills you pay for your mobile, broadband, electricity, your maid salary, driver salary, gardener salary, whatever helper you have, grocery, household repair, maintenance, education, vehicle expense, those kind of, your lifestyle expenses. Now that is also mandatory, that is essential. After deducting all this, what you have is your net disposable income available. Now it's your discretion what you want to do with it. So from this balance, Basically, we deduct all the discretionary expenses, right? Travel, entertainment, recreation, these are all discretionary expenses. It's not mandatory. You do it when you have income, and to the extent you have, or how much you can. You can stay in a five-star hotel, you can stay in a two-star hotel. It's up to you. So this is very discretionary. And after spending the discretionary expenses, whatever you left is the actual surplus you have available for investment. So in the above example, the balance surplus left for investment is rupees 43.8 out of the total income of 133 we saw in the previous slide. Now, so basically, note down and track your outflows under these five sections: mandatory expenses, all your taxation, PF, etc., fixed liabilities, which are your EMIs, the essential living expenses, all those grocery, household, utility bills, etc., discretionary expenses, and then finally the investments. Now, to track each of these expenses, because you do it on a daily basis, you cannot keep opening Excel sheet every day and write down all the details. You can use any of the expense tracking mobile on your mobile. I use an app called Expense Manager. Then at the end of the month, I fill up the total of each expense category in the Excel sheet I have shown in previous two slides. So basically it takes me 5-10 minutes every month to fill up that Excel sheet, and I have a clear view of where my money is going. This is what any financial coach will teach you, and this is what any common person does. Now I'll share my personal secret of what I did in initial 10 to 12 years. I switched number 4 and number 5. I just swapped the two. I first invested the balance left with me after meeting all my living expenses, and then spent the remaining on discretionary expenses for my leisure activities. I believe that this one change in approach helped me build a decent wealth over the years. Else I would have also been giving lame excuses like all others. पैसा नहीं है, invest कैसे करें? I don't have any surplus left with me. How do I invest? I think when there is a will, there is a way. जहाँ चाह है, वहाँ राह है. Once the income and expenses are identified and listed, it is very easy to assess where the problem lies, what our pain point is, if the saving seems to be inadequate, right? Till the income grows, the only thing you can do is to manage the expenses to enhance savings. If the fixed liabilities are too high, then a debt rationalization exercise with a financial planner may help you reduce the burden to some extent. If the discretionary expenses are high, you can figure out how to cut back and accommodate without compromising on the required saving. Example, staying in a very expensive hotel during a travel, you may choose a little less expensive hotel. So these need to be tracked and monitored on regular basis. I am still doing it for 30 years now. It's become a habit. I personally get a lot of comfort to see that my net worth is increasing year on year. And the best part is that it becomes a historic document to see how we are doing all over the years. Plus, it's a ready reckoner for spouse in case he or she has to manage expenses after you. They can just take it over from you in a snap. Hope you like this idea of keeping a track of income and expenses. In the next episode, I shall talk about the most important record we all must maintain to monitor our financial growth. So watch out. We put in a lot of thought, time, and energy in creating this video. So if you're finding this useful, please do share with others too. Do subscribe to our YouTube channel. We also have a Money Masterclass WhatsApp group. If you want to join, you can send a text to this particular number. Thank you.